Welcome back to the What Does It Mean podcast. I'm Lindsey Bell. I'm here with my co-host Bob Lang today. Chris Versace has the day off. Bob, we've got a lot to talk about. This is the beginning of October, and September really bucked the market trend. Let's just talk about what the market did in September. I mean, it was up 2%. Usually September is the worst performing month for the index. And not to mention that we're going into a very, contentious election period for November. October has typically done a little bit worse during election years. What are you expecting out of October? Is October going to buck the trend?
Well, I think we can change the name of this month to let's call it Rocktober. That's what we used to call it back. I was listening to rock music back in the day, when I was living in Los Angeles. We had a radio station there, KLOS, which was a rock station, and they had all sorts of celebrations for the whole month and called it Rocktober. I think we could probably call it that because I think the markets are going to get rocked back and forth like they have been for the past couple of months. Certainly at the beginning of September, we were not really sure whether the market was going to show some positiveness. In fact, we did have a positive month of September, Lindsey. It was the eighth month that we were up in 2024. We've only had one bad month or negative month in 2024. That was in April. So it's pretty startling. And the statistics, actually, if you look at them, Lindsey, bear out that when you have such a strong start to the year, and we're already 3/4 of the way through 2024, it bears out that the markets are going to finish strong into the end of the year. So seeing as though we do have an election coming up, volatility is elevated, and there could be a lot of chaos going on, the statistics still seem to bear witness that the markets are going to do well into the end of the year.
Yeah, usually the fourth quarter after a start to the year like this, the S&P is up 20% on a year-to-date basis going into October. So it does look good. It bodes well for the fourth quarter. It doesn't mean October is going to be great. You do see October become a little more rocky. So I would expect that to happen. It's all going to, we're going to talk about what some of the big drivers of the market are going to be once we get into the meat of today's episode. But I do think one thing is, what are your thoughts on that China stimulus package? I think September was partially driven by the August jobs report being Goldilocks. But then also we got this big bazooka from China. How much of a driver was that into the end of the month?
I think it was a bit of a surprise for most people, Lindsey, and I think that the China stimulus really tells us something about the Chinese economy, that it's in really bad shape. It's really weak. And if they needed that sort of stimulus, why all of a sudden were people starting to come back and buy these Chinese stocks? For the most part, I think a lot of names that I follow, the short interest was pretty high. I think a lot of people were looking for even worse numbers from the Chinese economy and thus Chinese stocks. And they got caught looking the wrong way when money was starting to flow into the Chinese economy via the stimulus. And I think that in and of itself caused a little bit of a movement here for the past several days. And I think that is not really the way to build an economy. And just my opinion is I think you got to pour that money into the economy, into the people, into projects, into the infrastructure, that sort of thing. Stimulus into the economy is just a short-term solution, just a Band-Aid on it, and it really doesn't fix any permanent problems.
Yeah, it's just a near-term shot to the system. And I think that is the question with China. Is this stimulus going to really lead to a pickup in economic growth? And I think that's TBD, just like you said. So, I'll leave it there for now. When we come back from this little break, we're going to talk about the impact of Hurricane Helene in different parts of the country, what it means for insurers. We're going to talk about the September jobs report that comes out on Friday and why it is so important. And then we'll close with healthcare stock. Yay or nay, do we stay invested or not? We'll be right back. Welcome back to the show, Bob. I know we want to dig right into it with hurricane season and Helene devastating not only Florida, but I'm here in Charlotte, North Carolina, as you know. And we had a lot of rain, a lot of winds. I've got some big trees. If you know anything about Charlotte, there's these big water oaks that line the streets. It's beautiful. A handful of them came down in my area, blocking streets, impacting traffic. We had some power outages. We weren't specifically impacted, but if you go just a little bit west of here, Asheville, Boone, North Carolina, they got very significantly impacted, Bob. It's very sad to see and hear and to watch the news. What you're seeing is that not only power is out, people don't have access to just clean water. They don't have power. There's not gasoline. People are literally stuck and can't get out there. And that's just, what I'm hearing about this area. There's other parts of the country that have also been impacted, right?
Yeah, Lindsay, I saw some of the news reports and some of the cars that were stranded and people flooding. I even saw some houses floating down the street. It's very, very sad and devastating to the area that really does not need that sort of devastation. I don't know if any area of the country needs it, but certainly in the South, in that area where you live, it really becomes a big problem, not just from an emotional standpoint, but also from a financial standpoint. I think it's going to be very difficult to try and get some of these homes rebuilt, get people relocated and so forth. But of course, in that area, it's nothing new. The devastation from storms and hurricanes and natural disasters, nothing new. People out there are used to this sort of thing, especially out in Florida, where we have hurricanes just about every year. And we're right at the start of hurricane season, and it could be lasting all the way till November. Sorry, everyone. But we could be lasting to the end of November before hurricane season is over. And I think that if you talk about these areas over here that need to get rebuilt here, I know we have an election coming up over here. These are areas that are really important to talk about, right? I mean, especially North Carolina, which is a swing state. Are they going to be helped by the current administration? Are they going to be talked about quite a bit too? And I think Kamala Harris and even Donald Trump are going to be visiting these areas in the next couple of days to see what these people need.
Yeah, no, and I think too, some of the news reports I saw and the impact in North Carolina, you saw them just talk about the locals and the small business owners were just the state wasn't ready. They didn't prepare us. They knew the storm was coming. It took a couple of days to get up into the Carolinas. And so there's a little bit of a disappointment there. But I think too, we like to look at what is the impact from an investment perspective. And I think you pulled a really interesting stat that 2024 hurricane season is expected to have a $181.7 billion negative impact to GDP for the United States, just based on 3 storms that are coming up. Is that right?
That's correct. And it seems like these natural disasters here have a huge economic effect on the country. I can recall back, Lindsay, probably about 12, 13 years ago when President Obama was starting to help dig the economy out from the financial crisis. And I think it was a couple of Januaries in a row, I think it was 2011 and 2012, if my history is right, that there was huge snowstorms that really halted the economies from digging out of the hole that we were in from the 2008, 2009 period. Well, this is no different. And I think that, unfortunately, the devastation and the financial problems that come from these natural disasters put a lot of pressure on the economy. But, that's a negative. On a positive note, you got companies like Home Depot and Lowe's who are going to benefit from some of the rebuilding and some of the fixing of these houses and so forth. So if you want to, put a silver lining out there, I think that probably be it. But it's certainly a financial devastation over here. And hopefully we get some of these people back in their homes very, very quickly.
Yeah, no. And I think another area too, when you're looking at it from an investing perspective, the stock market perspective, is the insurance companies. And I went and looked at some of these stocks, that the insurance companies that are levered to catastrophic type of events. And if you look at Assurant or Reinsurance Group of America or Arch Capital Group, these stocks have just blown up. They have outperformed the market significantly. They've outperformed the financial services sector. Some of them have even outperformed the insurance company industry. So these stocks have done really well. What's really been driving them is okay, over the last year or two, the Fed hiking cycle definitely benefits these because they're obviously invested in many fixed income products to help kind of offset their costs. But they've been able to push better pricing across to the consumer. And that's because there are more and more of these catastrophic events happening. And so what do you do as a consumer if you live in an area where you're exposed to water or winds or fires, right? If you're thinking about West Coast, you want to make sure that you have insurance in place. And not only that, so demand for it increases, then renewal rates increase. And every time you renew, they have the opportunity to increase pricing. And if they say, hey, look, these type of events are occurring more often, we need to protect ourselves. You need to protect yourself. We're going to raise prices. So what you've seen is, I saw a Deloitte Insights report that says gross premiums for these type of events are estimated to increase sixfold to $722 billion by 2030. Great for insurance companies, not so great for the consumer, right? But the insurance industry is rate sensitive, like I mentioned. And so with interest rates coming down, surprisingly, these stocks have held in there. And I think maybe that speaks to, I know we're going to talk about it a little bit later. I think it sort of speaks to this idea that we are potentially heading into a soft landing. The Fed's not going to have to cut as sharply as some people had initially expected or had initially hoped for. And then the other thing that these insurance companies have for themselves is diversification. They're getting into cyber security, ensuring those type of incidences. So there's just a growing business, and these stocks have done well. Do you think they can continue to do well?
Well, what I was going to say to your point about people just staying where they're at, it's all, what do they say in real estate is location, 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 right? And, having grown up in the southern part of California, we have an area called Malibu, right? And it's a small little community. A lot of very wealthy people live in Malibu, and there's some wealthy areas in Florida as well too. Of course, West Palm. But I remember for many years where there were natural disasters all the time, and it was always asked, why would people live there? Why wouldn't they move? Why wouldn't they just get away? There's fires, floods, earthquakes, you name it, anything there, and your home is threatened. What are you going to do? Well, I'm just going to rebuild. I'm just going to stay there. Why would I leave? This is my home. This is where I grew up or something like that. Or this is where I'm going to stay for the rest of my life. Why wouldn't I rebuild here? And it's crazy, right? Man, there's so many other places to go around the United States here, but people want to stay where they're at, and they will pay enormous amounts of money to rebuild their homes. They'll pay enormous amounts of money, as to your point about insurance, to insure themselves. I read something not too long ago that insurance rates in Florida, Lindsey, are at the highest rates ever for homes. And yet people are still going there, flocking there for the other times of the year when there aren't any hurricanes. But it's really pretty mind-boggling to me. But I get it. People want to live where they want to live.
Yeah, no, I mean, your family's there, your friends there, your job's there, all those things will keep you in one place. So, but I just think that, the impact, the personal impact from storms like this is devastating. The impact for these companies, it benefits them from a pricing perspective, right or wrong. That's the way it works. And yeah, I just think it's something too, like we talk about inflation all the time. Insurance is one of those costs within the inflation number that has ballooned, and it doesn't seem to be slowing down anytime soon, even though we see the composite index of inflation, whichever one you want to look at, is moderating nicely. There's still like components of it that are significantly higher too. So what does it all mean, Bob? What does it mean from an investment perspective?
Well, from an investment perspective, I think we all have to be concerned about the potential losses that some companies out there are going to have. There's going to be a huge benefit for some, maybe the home builders, maybe the home retail stores like a Home Depot and a Lowe's, but certainly the devastation there for people is going to be quite traumatic. It's going to have a huge effect on the GDP. It could draw down, I saw some estimates there, Lindsey, could draw down GDP close to 1% in the third, maybe even possibly the fourth quarter. If we have more storms like this happening with a devastation of Helene, it could certainly impact growth and impact where we're headed into 2025, which seems, as you mentioned, it could be a soft landing. It's a soft-ish landing or something like that. But I think the Fed's going to have to pay attention to this as well too, and realize that nothing happens perfectly, as much as you like to set the table that way. But hopefully we won't see very many of these storms till the end of the year.
I'm knocking on wood, Bob. I'm knocking on wood. I hope you're right. But that was also a very nice segue to our next topic here. We want to dive into the September jobs report. Do a little preview for our listeners, right? The big number comes out on Friday. I looked at Bloomberg estimates. They're looking for 144,000 new jobs added in the month of September. That's a tad bit higher than what we saw in August. The unemployment rate is expected to hold steady at 4.2%. And wages, I saw on Bloomberg, the wage growth is expected to be 3.3% year over year, which is quite a bit lower than the 3.8% year over year growth rate we saw last month in August. I think it's important to let's just kick this conversation off with Bob. I think most people want to know, why is the job number so important? Why do we always talk about every month? Oh no, jobs reports coming out again this Friday, first Friday of any month. What does it mean? Why is this such an important number? What's the number one reason why people should focus on the jobs number every month?
Well, there's really two reasons for it, and it's really basically talking about the economy on one hand and Fed policy on the other. Remember, the Federal Reserve has two mandates. It's to stable prices and to promote full employment. Those are the two mandates from Congress that is charged to the Federal Reserve. But I do want to say something about the jobs report as it is. Let's remember something. This is just an estimate, right? And the estimate will be revised somewhere down the road. Do you remember a couple of months ago, we talked about the revisions to labor report? There was like apparently 870,000 jobs missing or something like that were misreported. Well, I think people take this estimate with a little bit too much fervor here. I think they really have to take it more with a grain of salt. I'm not going to tell the markets what to do. I mean, if the market's going to react the way it does, then so be it. I'm going to have to go along with it. But I think, frankly, the number that we get this Friday and every Friday, the first of the month, should just be taken again with the grain of salt, because it is going to be adjusted, and the numbers that does come out is not going to be the real number. I think it's important to understand that the Fed takes this number also with a grain of salt. So what does that mean? That means the market is always going to overreact or underreact to what this jobs number is. And that creates a lot of anxiety, a lot of stress, and as such, a lot of volatility. So I think that, from that standpoint, it is an important number, but it is just one number.
I think you bring a couple of really good points. It's an estimate, that's for sure. But even though it's an estimate, it is an indicator of the health of the consumer, which is an indicator of the health of the economy, because the consumer accounts for 2/3 of the economy, right? So that's why people watch it just from an economic health perspective. But your second point on the Fed, right now, why is the jobs report so important? It's become even more important than previously, because this is the number that really has taken the forefront, has taken the stage, is taking on greater weight with regards to what the Fed is going to do with regards to monetary policy going forward, because inflation is seemingly coming under control. It's moving in the Fed's favor towards where the Fed wants to see it. So now the Fed has made it very clear that they're mostly focused on the consumer and the jobs report. And like you said, the Fed will take it with a grain of salt. They're data dependent, and there's not only one number that determines where they're going to go and what they're going to do. But you have seen the non-farm payroll report that comes out every month. It has created much more volatility in the market than any other economic indicator on the day that it's reported, I should say, than any other economic indicator. When you look at the averages since 2018, it creates the most volatility. More volatility than when the GDP report comes out, more volatility when the CPI report comes out, more volatility than when the manufacturing PMI report comes out. This is based on an analysis done by Bank of America's research department. So it is important. It will move markets that day. It doesn't mean it's going to go that way for the next several weeks, right? But it's something to pay attention to. The other point I would make too is that the payroll number is actually a lagging indicator, meaning it's backward looking. It's not forward looking. So it tells you where we've been. It doesn't tell you where we're going. And so I think that's like maybe goes along with your grain of salt commentary. So I think that people are expecting the report to, like I said, 144,000 jobs added, 4.2% unemployment rate. That's a decent report. It's not too hot and it's not too cold. So I don't know if we want to use the word Goldilocks, Bob. I don't know if you would do that, but it should be a decent report. And to me, if we come right in line with what expectations are, to me, that's further evidence that the Fed is only going to move 25 basis points in the month of November at their next meeting when they review monetary policy, What are you thinking? Talk to me about, we heard Powell speak at the beginning of this week about monetary policy and the movement that he's expecting. Give me a summary of that for our listeners and what you're expecting the jobs report will mean for Fed policy.
I heard quite a bit of Chair Powell's talk yesterday with the Economic Club. I think he was out there in South Carolina, or no, Tennessee, excuse me. He was in Tennessee yesterday talking with a slew of economists. So what he actually did say that they're looking for about a 50 basis point cut between now and the end of the year. So we have two meetings. So he might be splitting, one in November, one in December, or another double for November and then nothing in December, or vice versa. I don't think that the market was too pleased with that. In fact, we did see the market sell off on Monday about 0.75% at one point, did rally back. But I don't think the markets were too pleased with hearing that. And in fact, the Fed funds futures have dialed it back a bit to maybe only 2.5 rate cuts as opposed to 3.5 they were pricing in by the end of last week.
I'll just jump in and say pretty much squash this idea of a 50 basis point cut in November.
So I think that we'll probably see that 25. Look, Chair Powell did say yesterday, one rate cut move is not really in the cards. It's not really needed to have a tight policy right now, especially since inflation is trending in the right direction and moving towards their 2% goal. It's not there. He referenced yesterday pre-pandemic levels where inflation was flirting around between 1.7 to 2%. He didn't say 1.7 is the target. He said 2% is the target. We're moving in that direction very, very slowly. It's a gradual move. And now the attention...
Wait a minute. Do you think that means that Powell thinks that the appropriate rate of inflation is below 2%?
It could be. And he mentioned that 1.7. I was a little surprised to hear him say that because he said that somewhere between 1.7 to 2% is where we were pre-pandemic. And of course, policy was pretty much stable there when we were in that zone. So you're onto something, Lindsey, by mentioning that, because I think that perhaps the Fed may be looking for a lower rate than their target of 2%.
I think that's a little bit interesting because to me, there's a lot of structural drivers of inflation that suggest that, below 2% might be difficult to achieve, like demographics, just deglobalization. There's so many different things going on that impact inflation. So TBD, right? Obviously, we're going to keep a close eye on it going forward. But another thing too, just to kind of wrap this up too, that the dock closures that started, how is that going to impact this job? We're not going to see it in the September jobs report. How's it going to impact going forward? Do you expect it to have a big impact, or is this going to be something that kind of is resolved quickly?
If it's extended for a while, it could have some impact. But let's remember something. The dock closures are really impacting goods inflation. Where we've had the higher inflation, Lindsey, has been in services, right? So this is really not going to impact services inflation as much as it would for goods inflation. So if this is a prolonged strike, if they're out there for a long time, it's going to impact goods inflation. I don't think that for the holidays, though, I think that a lot of these companies out there who are doing their ordering have already probably put that in their plan, the impact of a potential strike. And they probably already bought stuff, and it's probably on ships right now coming out here, and they may have some workers out there unloading stuff, or if it hasn't already been done. So I don't think, for instance, it's going to impact the holiday season, which I know a lot of people have been talking about and been worried about. And again, this is about goods inflation, which hasn't really been a problem as it is right now. So going forward, I unless it's a 2-3 month deal, that it could have an impact. And as we know, President Biden is a very pro-union president, and he's going to side with the workers on this one, as he always does. He can certainly step in there and stop the strike if it becomes too much of an economic issue here. But I don't think at the end of the day, we're going to see too much of an impact from this.
Yeah, that's not the baseline case that the president's going to have to intervene. But I will say, to your point, the companies that are most impacted by these Eastern Gulf Coast port closures are Walmart, IKEA, Samsung, Bob's Discount Furniture. Those are the top of the list. They bring the most in through there. But like you said, I think a lot of them are ahead of it. So that's good. But we'll keep a close eye on it. So what does it all mean? Getting back to, we're talking about the September jobs report that we get on Friday. I think what it all means is that, yes, we need to keep a close eye on it because the jobs report this month has implications for Fed interest rate policy and the speed at which reductions occur. So I think it's gonna create volatility in the market on Friday, perhaps in the weeks to come. It's an important one, I think, this month. And so it's not just that headline number. Look at wage growth, look at the unemployment rate. I personally, what I'm going to be looking at, Bob, is the differential between part-time workers and full-time workers, because we've seen a tick up in part-time workers when companies aren't really doing hiring right now. We saw that with the JOLTS report at the beginning of this week. And so, I just want to kind of dig into that and see exactly what's happening with the labor market. That's an important one. Final topic for today, healthcare. Healthcare stocks have been beaten down this month, Bob. They are down 1.8% in the month of September versus a 2% increase for the S&P 500. The only sector doing worse is energy. And that's because energy prices had been coming down before the geopolitical increases in tempers that have occurred at the beginning of this week. Year to date, healthcare has underperformed as well. What do you think of the healthcare sector?
It's interesting that these healthcare names have been performing so poorly. I think that by and large, a lot of these companies have really good, strong growth prospects. A lot of companies like Merck and Eli Lilly and even Pfizer, to a certain extent, have some good pipelines with drugs coming through. They pay nice, solid dividends, which, of course, with bond yields starting to come down, pressure on yields down, people are clamoring for bonds right now, fixed income. And as that happens, the yields come down. You have to find a comparable investment. And if I can get a 5% yield from Pfizer versus a 3.6% yield in the 10-year, I'm going to take Pfizer every day of the week because it's a good, solid company that the dividend seems pretty safe. And I'll hang out and wait with a higher dividend yielding stock while the economy is still rather strong.
I was looking back because this is a sector that I, at the start of the year, really liked because I just expected a handful of uncertainty from a lot of different places while the economy began to potentially normalize and earnings recovered and, also normalized. But it hasn't been the best performer. It's on a year-to-date basis also has underperformed quite a bit. But if I look up until August, it was hanging in there. It was like the, 1, 2, 3, 4, 5, 6th worst performing. So it was like in the middle of the pack going into the month of September. And then I think the idea of a soft landing solidified a bit more with the August report, maybe with Powell's comments this week. You just saw a really strong end to the month. And so I think that folks went to different parts of the market. Healthcare is a really good sector. It's a defensive sector. It's like for the dividends, like you talked about, it's a really good sector to be in periods of uncertainty. And I think I'm going to stick with it through the month of October, given the uncertainty, just because I think that heading into the election, there's going to be, increased volatility in the market in the month of October, which I'm sure you have thoughts on. But I think also getting through the election, because it's, the probability of the election being done on election night is pretty, I think slim. I don't know what you think. We'll see. But I just think this is a sector that when the S&P 500 goes through rocky periods, healthcare does do well because it's defensive. Not only that, the earnings are able to keep up and remain resilient throughout periods of uncertainty. I mean, throughout most of this year, you have seen hiring, you're seeing innovation. You talked about some of these pharmaceutical companies doing the weight loss drugs, which, by the way, those stocks most of them have done really well this year. But we've got the aging population, which I briefly mentioned there too. So I think there's a lot of tailwinds for this group. That being said, if we are getting the soft landing, once we get past the election and we get a little more clarity in different parts of the market, I do think that there's probably better opportunities in other places. But I think it's a sector that I'm going to continue to hold through at least the next month. Not that you should, I'm a long-term investor, But I just think that a soft landing could indicate better opportunities elsewhere longer term.
I think a lot of these investors out there were hiding out in some of these weight loss GLP-1 names like an Eli Lilly or a Novo Nordisk and some of these other names that caught some tailwind from the news from those drugs. And a name that I own that I've had for a while is called Viking Therapeutics, which has a competing drug, and they're working on an oral solution for this. The stock, I bought it at $12, went all the way up to like 90. It's been still in the 60s right now, so the stock is up quite a bit. But a lot of people were hiding out in names like Lilly, and even Amgen came out with competing drugs. So these sort of things, I think that the hype from this whole weight loss thing mushroomed and ballooned a lot of these names and got a lot of people excited about it. But I did want to share one area in the healthcare region that you were discussing here a moment ago, because we did talk about insurance earlier. And when you talk about the HMOs, this group over here has severely underperformed, Lindsey. And if you look at names like Elevance, which we have in the Street Pro portfolio, United Health, which has gotten slammed, Cigna, a lot of these other names have just gotten hammered due to some regulatory issues and Medicare repayment, reprocessing of the amount of repayment that's going to be made by the government. These names are your traditional names that you'd like to buy for the long term. They've just been hammered. And even though the yields are still pretty good, I think the jury is still out on these names until we get some more clarity on policy for some of these HMOs in 2025. What do you think?
Yeah, no, I think you're right. And it's funny, like I have this conspiracy theory about healthcare sector because of the weight loss drugs, which, by the way, yeah, Eli Lilly, what a rock star. It's still up 50% year to date, but it was down almost 9% in the month of September. Novo Nordisk, too, down 10% in the month of September. That's down 20% year to date, though. It's not doing as well as Lilly. But, you have to wonder, these weight loss drugs are impacting people's health, improving people's health. So there's less need to potentially go to the hospital or for other treatments and less things going wrong. I mean, they have their side effects, don't get me wrong. But you're also seeing, I've noticed in the month of August, when we talked about the jobs report coming out, healthcare hiring actually is slowing. I know that was one of my reasons for owning the sector earlier this year, but it is starting to slow in August. The job ads in the sector were about half the average monthly gain over the prior 12 months. So it's hard to say. So that's just my little angle on conspiracy theory in the healthcare sector. Maybe it has slower days ahead because of the health of the consumers getting better in this country. I don't know, Bob. Am I crazy?
Well, I don't think so. But then again, you look at names like Tenet Healthcare and HCA. Built these stocks, Lindsey, up over 100% in 2024. Crazy, right? I mean, especially THC. Stock started this year at 75. It's $163 a share right now. Near all. I just hit all-time high last week. HCA is another one, out there in Tennessee. Another one that was 270. It's up, 65% in 2024. So there are areas in the healthcare segment that are performing pretty well. And I guess if these hospital stocks, as people who are sick and they need to get into the hospital, those are the ones that are performing really well. So there are some pockets of strength over there, but I think by and large, I'm with you. I would hang in there with the healthcare names. Some of the names that you mentioned earlier, I think are going to be strong, especially coming into the new year, 2025.
All right, Bob. Well, so I'll just wrap it up real quick. What does it mean? I think you summarized it perfectly. I think healthcare is a sector that you can hold on to for a little bit longer, but maybe to your point, it means that you have to be stock selective with regards to investing in this sector, because there's going to be winners and there's going to be losers, and maybe this sector has become a poster child for that. Well, that'll do it for the meat of the show. We'll be right back after this short break to wrap it all up. All right, welcome back, everybody, to the What Does It Mean podcast. Bob, let's wrap it all up for everybody. What was your biggest takeaway? What did you learn in today's show?
Well, about the dock worker strike coming up, and it's really getting started right now, and the impact that it could have on the economy and the jobs report as well, too. And that could be a big market mover and certainly is going to help the Fed craft policy in terms of how fast or how slow they're going to be with their dovish interest rate policy. Are they going to go 50 this month? Are they going to go, or next month, they're going to go 25 or whatever? And possibly how fast or slow they're going to be going in 2025. But basically, this year is over. We have another, well, I'm not going to say the year is over, but we do have another quarter left to go, 2 more meetings. I think they, at least one rate cut, maybe 2 are already baked in the cake. Now we're looking at 2025. And what's the forecast going to be for that? I think the Fed was talking about maybe 3 rate cuts in 2025. This jobs report is going to go a long way in helping us to determine, and every month, every jobs report for the next 2 months is going to go a long way to help determine how that policy is going to go.
Right. Well, the Fed is indicating 2 rate cuts for the remainder of this year. So 50 basis points, 25 at 2 of the meetings. And so I think for me, the big takeaway here really is that there's going to continue to be noise in the data over the next several months between the storms that we talked about, between this dock closure that's going to impact the October jobs report. So even if September looks good on Friday, is that perfect Goldilocks number that the Fed's looking for, October might be a little bumpy, might look a little worse because of the dock closures. And so that's going to impact things, and the Fed's going to have to look through that. And as much as they want to be data dependent, I think what it all comes down to, and it's been the case for the entire year, is that you got to look beneath the surface. Don't just trust the headline numbers. Look beneath the surface. There's going to continue to be noise in the markets, but don't let that ruffle your feathers. Just know that it's all a piece to the puzzle, creating a mosaic of what the market is going to look like into the months and years ahead. And we remain optimistic, right, Bob?
Absolutely. I'm very optimistic and glass half full over here, Lindsay.
Same. Well, that's going to do it for the show this week. Thank you so much for joining us. Make sure you check the show notes and the resources on advisorpedia.com. Check out explosiveoptions.net to find Bob. You can find Chris Versace at the Street Pro Portfolio, and you can find me at The Shift and my newsletter, lindseybell.me. Thanks again for listening. We'll be back with you next week.